You and me were talking last week. You used the word volatile. This is almost a volatile market when it comes to talk about rates and so forth. Kind of give us some insight to what you're seeing on your side out there.
Yeah. So there's a lot of sticker shock in the market right now. People are used to, the last couple of years, during COVID, where rates were suppressed down into those under 3% range. Right now, you have a lot of volatility because not only do you have inflation hitting the market, you also have this Russia-Ukraine thing that's happening right now also. So what you're seeing any day, whenever you're comparing interest rates between lenders, you have to compare rates and costs. And we're going to get into that a little bit later. Just because when rates come out at 8:30 in the morning, they could have changed 3 times by 11 a.m. Okay, so rates, customers have to get used to that. Primary resident rates, they're back up into the upper 3s, low 4s, depending on your portfolio, and that's okay. That's something that I always say. Everybody wants low rates, but everybody wanted COVID to be over so we can move back to some normalcy, right? So just make sure your lender is calculating your payments using a high-end estimate, always giving you a worst-case scenario, so it's always better as you move forward. Rates one day to the next. 2 weeks ago, sorry to cut you off there, Mark, but 2 weeks ago, we saw a 0.75% swing up and down, back and forth over 3 days. That doesn't usually happen over the course of a full year. Okay, so just realize it's very volatile out there. Make sure your lender knows what they're doing, keeping you informed, and also has a float down option. That way during the process, you can always get the best rate available.